Well, last week's storm caused significant damage to farm structures across the Midwest as well, some of which are now beyond repair and will need demolished. That's leaving producers looking for guidance on property tax treatment of associated costs. Well, Roger McEowen with the Washburn University School of Law joins us now with some clarification in today's Rural Money segment. Roger, as always, thanks for taking the time to chat with us here today. So let's start with some of the general rules, of course, associated with demolishing these farm structures.
Yeah, good to be with you today, Janet. And a tough week for a lot of producers past few days in Iowa and Illinois and across Indiana, but particularly in Iowa. But there is a specific code provision that says when you demolish a structure that you can't claim a deduction for your demolition costs. You're going to have to add the cost of that demolition into your land basis. And there was also a provision that was enacted back in 1985, starting for tax years after 85, that says you can't get a current deduction for removing trees and stumps and brush and other expenses associated with clearing land to make it suitable for farming. So if that's part of it too, you can't get a deduction for that. But any use of that property before you demolish it, of course, you can take depreciation deductions for that. So general rule would be, you're not going to be able to deduct your demolition costs.
So in regards to last week's storm, how does that demolition after casualty play a role in the tax treatment?
That's where an exception comes into play, is if you have a casualty and then the building or structure is beyond repair and now you have to demolish it, your normal capitalization rule doesn't apply in that situation. So, the normal rule of adding that cost or capitalizing it to the land basis doesn't apply. Instead, the basis of the structure is reduced by the deductible casualty loss before the loss sustained on account of the demolition is determined. So I get a casualty loss deduction, and then you can demolish the structure. So what that means is for a farm building or structure that was destroyed in the recent inland hurricane, for example, that income tax basis in the building or structure at the time of that hurricane would be deductible as a casualty loss, but the cost of cleaning up the mess left behind would be capitalized into the land basis. So in essence, the loss sustained before demolition is not treated as being sustained on account of the demolition, with the result that that loss isn't disallowed. It's treated as an abnormal retirement caused by unexpected or extraordinary obsolescence of the building. So you get a casualty loss deduction, and then you take your cleanup costs, your demolition costs, and add it into the land's basis.
A lot of information for folks to keep in mind. Roger, as always, thank you very much for your insight. Again, Roger McEowen, he's with the Washburn University School of Law, joining us on the phone today from Topeka, Kansas. You can go online to washburnlaw.edu/Walter for more information.